Welcome to the Dividend Talk podcast, episode 115. Invest in high quality stocks during a recession. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to give 3 picks each on high quality stocks that we would invest in during a recession. All that and more. See you on the inside. Hey European DJ, how are you this weekend?
I'm good actually, but tell me more about yourself. I heard you had a bit of a bad Friday.
Yeah, I've had the flu this week, so it's children have gone back to school, which usually means they pick up all sorts of bugs and flus and stuff. So it was our turn, which I'm quite glad because I'm going away to Malaga next weekend, and I do not want to be sick for that. So I was glad I got it this weekend, got it out of the way. But I'm all good now. I'm all good. So
Okay, so it
how?
was not the stock market that got you sick.
No, but do you know what? I don't really look at my portfolio, or at least the value, and I looked at it the other day. For I don't know, I think I was my son was asking him questions, and I was just showing him, and the amount of red in there, and he was like, "Oh my God, Dad, you've lost that much money." I was like, uh, "I haven't lost it yet because I haven't sold anything, but yeah, it's pretty horrific at the minute." But on the other side, there's so much stuff to buy. It's crazy, like,
Oh,
isn't it?
it's a candy store. I tell you, it's really a candy store. And I guess there's also a topic of today, right? How do you choose the right candies? Not those
Yeah.
make you sick but give instant gratification. But how do you take those sweet ones that you know will give you memories forever?
But it's crazy because look, we'll get to the news of the week and what's going on, but it's the market's dropping, and I fully expect it to continue. Like there's been no news or no glimmer of light to say that is giving me hope that we're going to turn the corner on this, even fundamentally or from a technical point of view, looking at charts. And you get to a point, and I get to a point where I'm like, do I just wait? And it's in your mind constantly, but I have to force myself to okay, I'm putting in €1,000. I'm buying companies, and I have to do that. And I put triggers. I told you I put triggers on HPQ, which got
Hmm.
triggered. That got triggered, and so did something else. I think it was Tro got triggered. So my money is in, and I have bought stuff, but it just plays on your mind the whole time. Do I wait? Do I wait? Do I wait? And it's just so hard. But it's look, I think for the next 2 or 3 months, it's a nice problem to have.
And you're still option trading, I guess, in these markets.
I I am I am, but mainly now. So I usually do cash secure puts, which obviously is harder in a market that goes down. So I've have my fill of companies that I'm willing to own. So I won't be doing that. So I'm selling covered calls now. On those, the problem with the covered calls is I don't want to do below my cost basis, and if the
Hmm.
market keeps dropping, that means I'd have no choice but to do that. So I might end up that might go on hold until
Yeah.
the market looks like recovering.
For me, also option selling and let's say option trading is not for the type of option trading we do. It's not too good to do that during these kinds of volatile times. More during peaceful times, you can really
Yeah,
earn some additional yield. But under these times, you can be really quickly underwater. And I still have some Intel options outstanding, a
yeah,
put option 35. So I'm big in the minus there. But hey, I bought it fully knowing that I want to own it at 35. So I'm sticking to that. And yeah, I hope I will get some 100 shares by the end of October. Of course, with the knowledge of today, I would have liked to have it at 27 or 28. But honestly, I would have bought them at that time for 35, right?
yeah,
They were
yeah.
trading around 38, 39 at the time. So it's still a bargain from that point of view.
The big one that I've done recently is VF Corporation. I don't know if you know them. They
Mhm.
do vans and what else? North Face and those
Yeah,
sort of
yeah.
brands. They're really good dividends. So they are the last cash secure put I have on them. They were trading at about 50,
Yeah.
and I remember saying I'd be happy to own them at 42. So I put in options for that, and now they're trading at something like 35 or 36. So I have that outstanding, so I'm probably going to get assigned those. And I have BASF, I have a cash secure put on them at €35. And honestly,
Mhm.
if I get assigned them at €35, I'm happy. I'm not as
BASF is
happy.
a nice one.
Yeah, I
Yeah.
think I'm more than happy with that. With VF Corporation, the way the market is now, they could drop another 20%. And given the industry that they're in, it might take them a little bit longer to recover. But
Mhm.
on the flip side, I did say I was going to focus on solid dividend companies, which they are. They have a decent-ish balance sheet. It's not the best, it's not the worst, and they do have growth potential. So I'm not too worried about it. But they were the types of companies that I transitioned to rather than the likes of who did I have, Wish and Solo and
Yeah,
all them
exactly,
kinds of crap.
exactly.
So
Yeah.
I'm more than happy to have these and be a little bit underwater and collect dividends. It's the likes of Wish, Solo, and CCL. I think are the three that I have that I think I'm just going to end up owning forever until they go out of business. I'd say. So, but hey,
Yeah,
you
good.
live and learn, don't you? You live and learn.
Exactly, exactly. So let's have some really good stuff then, right? This is what we're investing for because
Yeah.
finally Microsoft increased their dividend by 9.7% to 68 cents per share. I
You
mean,
were
I'm so
so
happy with this.
impatient. You were so impatient with that. I was laughing on Twitter every day, tweeting, tweeting the CEO. It wasn't even the CFO or the CFO. I was like, where's the dividend increase? Where
Yeah,
is
the
it? Where is it?
CFO is not on Twitter. I could not tag. Was it Amy Hood?
Yeah,
So yeah, yeah. Well, that's a bummer, right?
it was quite funny, but I think quite a few people predicted the actual amount, 9.7
Mhm.
percent. I think 68 cents was probably obvious. It was probably where they were going to go. So it was,
Yeah, I was actually hoping for 70 cents just because it's a round number. But of course,
yeah,
that was more wishful thinking, I would say. But look, it's Microsoft, right? Second largest position in my portfolio, and it has now what is it, a yield on cost of 6.2% for me, while the current yield is 1.14. So it's becoming meaningful, I would say. Yeah, it's finally becoming meaningful with the dividends.
yeah.
It's of course by far not the highest dividend payer, but I'm so happy with these hikes. I'm so happy with these hikes.
I mean, they're consistent with those. It's an inflation beating hike. It's probably one of the few companies that have raised it above the current rate of inflation in Europe, which is sitting around 9%, 8.1 in Ireland actually. But I mean, look, they keep giving. We like dividend growth companies. We like good balance sheets. We like all that stuff. And Microsoft are just up there. Funnily enough, I had said it to you off air. I did not want to put them in our topic because I feel like we always talk about Microsoft. We always talk about certain companies. So
Yeah,
you might be surprised I'm not going to pick the usual companies, but certainly if you wanted to invest in a high quality stock during a recession, Microsoft should
Microsoft
really
under
be that
200 for you, right? Microsoft under 200. I remember
under 200.
180.
Yeah,
Yeah,
yeah.
yeah, yeah. Good.
So we see how that goes. And then we have the whole news with the Fed increasing the interest rate by 75 basis points. It was quite an interesting call. I was actually working on my dashboard. I remember I mentioned that last week. So I was working on that, and I came across Twitter. Somebody was live streaming it. So I don't normally listen to these things, so I listened in. It's quite different listening to Americans. Quite what I say, fluffy. Trying to make everything set. Actually reminded me a lot of some of our corporate meetings we have to do with a lot of Americans, and they're a little bit different to Europeans, which are more direct and straight to the point. And they're fluffy, trying to make it sound pretty good. And if you actually watch the market while he was talking, the market actually jumped up. So initially the news came out, the market came down, and then he started talking and it just rebounded up. And he made everything sound like really good. And then he stopped talking, and everybody went, "Wait a minute." it's not actually as good as what he said, and the market just crashed again. It was quite
Yeah.
fun to
No,
watch.
it always requires some natural language processing, right?
Yeah. Yeah, but it was interesting. It was also interesting for me to hear him talk about the housing prices over in the United States being inflated and that they pretty much need to crash, and they're probably, he didn't say it in so many words, but they're probably trying to make the housing market crash and come down to
Yeah,
more realistic levels. Like, but it was an interesting call. It obviously affects the stock market because, I mean, whatever chance we had of a turnaround, I think probably rested on that conference call, and it didn't seem too good. A lot of people were expecting actually higher interest rates to be 100 basis points, not 75,
yeah.
which
So tell me, when will you buy treasury, let's say bonds? At what yield would you be willing to do that?
whew, I don't know. I don't know. It'd have to be what are they at now? They're at
Well,
an
they will
all-time
be
high,
at
are they?
3.25. It depends, of course, on which one you take.
Still too low for me.
Yeah. I think at around 6%, I could buy someone, just something, just to lock it in, but not for a long duration, just for like 2, 3 years, something like that.
You look for, am I right in saying, is it 6 or is it 8% you look for in dividend growth?
Yeah, exactly. But at a yield of 3.25. So
Yeah.
if I could lock in, let's say 6% for 7 years, 8 years, that could be fine for me. Yeah, yeah, that could be fine for me, I would say. But of course, a small part of the portfolio. But then I think it is interesting to do some bond investing, right? What they always say, like, at a certain moment, you should have, let's say, when you're 40, you should have 20%, let's say, I don't know, in bonds. I mean, that rule applied maybe in the 80s or in the 90s, but not in the
Yeah.
last decade where you got nothing in return. So, but if it becomes like a 5, 6% yield or income, then it becomes interesting again, right? To consider it.
Mm. Yeah, I mean, look, the last 10 years we lived through the biggest bull market ever. Times were different. Anything that kind of applied financial wise, all the advice kind of went out the window. Everything just seemed to go up. We might see a period now. The last decade, was that in the 80s or 90s when everything was flat?
Well, also
Um,
2000 to 2010.
yeah, so I mean that could happen, and then investment have to you might have to change and adapt. Bonds are not something. It's not my strongest point. Let's be
Mhm.
honest. So I'd have to try and understand them a little bit more and go about them. But at the moment, 3% treasury, that's not
Yeah,
it's not good enough.
true. So really quickly then, also just a small heads up to people. We have a lot of investors in Intel following the podcast. This Tuesday and Wednesday, it will be Intel Innovation Day. Pat Gelsinger will be presenting, the CEO, and it will be also live available to watch on the on via the investor relations website. So if you're interested to hear what Intel is up to, if you want to see, let's say, a bit of a show again. Last year they were trying to set the world record for clocking. I believe they did. So of course it's innovation. It's not to do with delivery. That's usually the issue with Intel, right, of the last 2 years. But I'm very curious what they have up on the sleeve, and what we will also hear about, for instance, the new fabs that they are building. I'm really, really curious because, these are the things that many investors are looking for, right? Maybe they can say something more again about the EUV orders that are upcoming in 2, 3 years from now. So yeah, I'm really interested in the new product range potentially as well.
Yeah, will they release that? Do
Yeah,
you think?
last year I watched it live, and this year it's
Yeah.
also live again. So you can watch it probably also via YouTube streaming.
Yes,
I will put the link in the show notes.
I'll be in work Tuesday night, so maybe if I get a quiet moment, I might be able to watch it. Except for if my boss is listening to this, I definitely won't be watching it. Definitely.
Okay, then. Hey, this topic is really also about investing in high quality stocks during a recession, right? I think it's fair to say that, and we spoke about that a little bit last week, right? That if you look at our portfolios and specifically the investments that we made over the last 3, 4 years, often these were stocks with a story, because otherwise it was hard to get a decent yield. Like that was even, even worth waking up for, right? And Intel, we just mentioned, is a good name of that, but we had Walgreens, all these kinds of stocks, all with a story. Now, this market is, of course, giving us an opportunity because prices are down across the line. What I am observing, though, is that high quality stocks at the moment, those with, for instance, good balance sheets, are relatively doing better than other stocks. When I say good balance sheets, I'm not talking about Shopify or something like that. I'm really talking about blue chip companies like Microsoft's and the likes, Apple. They're doing fairly well, right? So what is for me really important now is to also use the recession as an opportunity to buy some, to strengthen the high quality component of my portfolio again, just to put some more foundation in place. This was just not enough possible. We're still not there yet, I would say. We still need stocks to go further down. I mean, even Johnson Johnson is just really keeping up. It's like, I don't know. It's like it's as concrete under the share price. Yeah, it's just not moving with the other stocks. It's really, really, really annoying. Why can't this stock just drop 20-30% like the others? Yeah. No, but don't you find that bloody annoying?
No, like it's funny you say that because I was I was having that same moment, the same thought the other day when I looked at my portfolio and I see all the shit companies I have and how much they've dropped. And then I was like, okay, lovely. And I went in and looked at Microsoft, and
Yeah.
Microsoft was up 6% or something that day. And I was like, what is going on? But then it also reinforced my thinking that I've been saying the last couple of weeks. I want to transition my portfolio into more quality. I feel like I have a lot of turnarounds and a lot of high healers, and I want more quality. But at the moment, it feels like I have to pay a lot more for that quality, which is understandable, and it's hard.
Yeah, but I believe we're not there yet. I still feel like we're just warming up with this bear market. So from that point of view, it is really important, I think, to consider what high quality means and what those stocks are. So today I actually also released a video about how to prepare for a recession, and I analyzed my portfolio from a credit rating point of view, and I've got about 20% in the lower medium grade or in the lower grade, let's say, credit ratings, but 33% of my dividend income is depending on that. So it's just a clear sign that I want to do a little bit more on this. It's not like I feel bad about it. I think my portfolio is still relatively well composed. Yeah, but it's really now time to strengthen the high quality pillar in my portfolio. So having said that, EMF, what is for you a high quality stock besides Microsoft and Johnson Johnson that we often talk about that you really like to start initiating a position in or actually double down on?
Yeah, so I try to stay away from the usual companies, but one company that I would really like to own, and their dividend yield is quite low, which would put me off it a little bit at the moment, and they're probably still a little bit overpriced. But one company I would really love to own is Visa. I think Visa is a fantastic company. I mean, when the pandemic happened, we know everybody went shopping online and you have to use your card a little bit more. And I feel like something similar will happen during a recession. I think when a recession happens, people will look for bargains. And usually, if you go down to your local store, you pay a little bit more. So what do? You shop online, you shop on Amazon, and you get it cheaper and you use your Visa card for that. I think they have such a strong business model. And I know there's talks of fintech coming in and there's competition with PayPal and so on. But I honestly think so many people have Visa ingrained in them at the moment. Every card is nearly Visa, particularly in Europe, and probably the US. But it's going to be hard to break that model. They talk about cryptocurrencies, talk about all these things, but I feel like it's similar to the Amazon story. When Amazon comes in, it's going to take over the world, but it's hard to break into something like that. So I think they have a really, really strong moat. They have a strong business model. They also have strong financials. Their dividend yield is low. Okay, so I would want that. Look, it's 0.82. I probably want that up around 1.2, 1.3, 1.5. I would be delighted with because their dividend growth is phenomenal. I think last year was at 17%, 17.94%. The dividend per shares after growing at a phenomenal rate. I have the chart up here. it's after growing from nearly was it under 10 cent up to 1.4, 1.5 it is now at the minute, 150 quarterly share. So it's fantastic growth. Their 10-year return just on price alone, and their dividend is 20%. So if you held them for 10 years, there's a 20% return on investment for people that like that. But at the moment, like we talk about quality companies holding up, they're still trading at a 25 PE ratio. I mean, I want these guys to come down. I want them to come down. I want a higher starting yield, but they are a
Yeah.
top quality company. The one thing I did notice though is that they've added a lot of depth to their balance sheet. I don't actively track this company. I don't actively follow them, but they've added depth to. They look debt free until 2016. I don't know what quite happened there. There must have been some sort of acquisition
Probably
or
some
something.
buybacks or
Yeah,
acquisition.
and it's been increasing slowly. Um, from then, it's at about 20 billion now. They have reduced it from 21, so maybe it's on the downward spiral now. But that's the only thing of concern. They have more debt than cash at the moment. But again, I would have to look into their financials, go back to 2016, see what they did to earn that, and see why it might make sense. But for me, Visa would be a quality company. American Express would be there with them, but I don't understand their business model as much because I know they target high premium users, don't they? And they have a
Yeah.
fee, a high fee to use that card. But for me,
Yeah, and American Express has the name term American in it, so it already alienates the rest of the world. I
yeah,
really have that feeling always. So it's
yeah.
not a wise choice for this company. But talking about Visa, right? Don't they have a gross profit margin of above 80%, 85% or something like that, which is really unheard of.
I mean, they have a really, really high margin business. I mean, it's perfect, isn't it? It's absolutely perfect.
Yeah.
Minimum cost and high margins.
And then I believe that they're like the railroads of the world, right? They own the network, and banks pay them to be
I
able
mean,
to put a Visa logo on their bank card. It's amazing.
they have partnerships with all the banks. They have partnerships with Apple, Google, Netflix,
Yeah,
Samsung. What else can I think of? Fitbit. You can pay
yeah,
Fitbit. I have a Garmin watch actually. You can
mm,
use Visa. They have all these brands incorporated. They're not going to
yeah,
move too easily. You can transfer payments across the world in seconds. I
yeah,
mean, I look. I think it's phenomenal. High margin
yeah.
business, high profit, plenty of cash flow, plenty of dividend growth. I just wish they paid more dividends.
So honestly, I analyzed them in a video last year, and I have
Yeah.
the fair value price at $182, and then
Oh,
with a 10% margin of safety at $164 as a potential buying price. What I must say though, I used a 13% annual growth in free cash flow over the next 5 years and 8% thereafter. So that is, of course, no, I wouldn't even call aggressive. It's more like in line with historical norms and a terminal multiple of 20. So, we can be more greedy now during these times. So
yeah.
I analyzed it at the time when Amazon UK wanted to stop accepting Visa transactions. So that's when the price went down. That's when I analyzed it. But look, for me, it's also one of those companies. You're spot on. They usually are not really on my radar because of the yield. But yeah, there's definitely high quality stock. And I don't see it easily being replaced by any other technology, even if Bitcoin would become, let's say, the norm or cryptocurrency, let's say. They will still be how I say, a major player just for the practicality and such. I believe, unless we maybe go totally virtual, maybe then. But until that time, I can't see. They have a monopoly almost with their network. So
I mean, they dropped during COVID. I remember they dropped quite severely. They dropped down to 130. I'm just checking out. Yeah, 135. They dropped to. That's 1.1% dividend yield at the moment. In the
yeah,
current market, if it goes, we could well see these guys drop maybe a little bit below that. So the yield
yeah,
might come a little bit more acceptable.
yeah.
Honestly, I think if they start dropping below 150, I might start buying a small. They're,
Hmm.
they're not going to be a huge part of my portfolio, but I'd still like
Yeah.
to own a small bit of these guys.
Nice one, nice one. So, mine shouldn't come as a surprise, but let's stay a little bit in the information technology space. So, not Microsoft touching on today. That's my darling. I have a lot of it already. But the company that I really, really want to accumulate more in is Texas Instruments. I started on this journey like half a year ago, I believe. I made 2 buys. I still have 5, 6 buys to go, six times to accumulate. It's currently trading at $161. It's 20% down since the last year. It touched on a 52-week low on 144. Not even too long ago, somewhere midsummer. But with the recent dividend hike of 7%, I believe it is now yielding at 3.08%, which is really interesting, right? Unfortunately for us European investors, also the US dollar is becoming stronger. What is it now? 0.97.
Yeah,
So I feel like the decline in the stock price goes in harmony with with I said a strengthening dollar. So is there a net benefit? Probably not, but I took really the position to really dollar cost averaging there and not take the dollar euro currency too much into consideration. Although I might be a bit more biased towards the euro. Texas Instruments, it stays the good old calculator. And sometimes when we put this on Twitter, people send their pictures of the calculator that's still working 20 years later. I really see the same with their analog chips and such. And even if there would be like a severe recession, I think Texas Instruments will be hit because, how is it has the cyclical nature in it. And if we just stop spending, it will hit the semiconductor industry as well. But I mean, the longer bull case for this whole industry is so strong. And in my opinion, Texas Instruments is really the company I want to really do the right with. I don't need to be at the novel edge of Nvidia, AMD, and Intel to that extent. Let Texas Instruments take the more simple chips and be excellent in execution in their manufacturing, and then have these awesome cash flow returns of what is free cash flow annual return of 14%. I'll
yeah,
take it anytime.
yeah. I mean, it's not bad for a calculator company, but you know what you get with these guys. They make a quality product. Their brand is known throughout the world. They're used in pretty much every industry that you can think of. Yeah, I agree with you. I think in a recession we might see them hit a little bit. Honestly, I would love for them to get hit like they did during COVID. They dropped to nearly 90. I'm kicking myself. I didn't buy a lot more back then, but they dropped to $90, something like that. I've been waiting. I've been watching them. I have my chart, and you're right. They hit that. So the 52-week low before they dropped to 144 was around 161. When they dropped below that, I was like, okay, here we go. They've broken the trend line. They're on the way down. Nah, they
Ah.
just rebounded. So I mean, the- I still
Yeah,
think they're
it's
attractively valued.
yeah,
I still like them at this price. Their yield is what, 3%. I like
yeah,
these guys with a 3% yield, given their dividend, the
yeah.
dividend growth as well, which is
For me, it's
low.
trading at fair value at the moment. So
But
high quality stock.
this is the one company that I struggle with. See, you can see the board behind me, but Texas Instruments is on top of that, and it's the one company I'm looking at. But I always think they're going to drop more. And I had this with Microsoft the last time.
Yeah,
And that's what's made me want to buy it. But I really feel in this market it's different to when I was buying Microsoft, because Microsoft was in
yeah,
an
true.
upward market. So
Yeah.
we will see.
Good. So what's your second stock that you would love to buy?
So the second stock that I would like to buy is BlackRock. I would really like to own BlackRock. You know, I have Blackstone in my portfolio, and Blackstone are a little bit different. They are both asset management companies, but then everybody knows BlackRock because they are huge ETFs. I mean, the ETFs are worldwide. Um, they are part of, I was just saying, oh yeah, their ETFs are all over. I think you get them on iShares. The revenue breakdown mainly is from administration fees, probably from their ETFs and all that. It makes up 78% of their portfolio. So it's absolutely huge. The revenues have been growing. I think they've nearly doubled over the last 10 years. Free cash flow is a little bit up and down, which is probably understandable given that they have to use some of that cash flow to buy companies or investments. The long-term debt is essentially zero. It's not zero. I think it's like 6 billion, but for a company of their size, it's essentially zero. Dividend per share is after growing 12% last year alone. The free cash flow payout ratio is 55%, which is quite acceptable. And their 10-year dividend growth rate is 11.63. And I talk about annual 10-year and overall total returns because I think that's important to some people, particularly if you're thinking about investing for a long period in a recession and you want returns. So over 10 years, these guys have returned 14%, which is quite decent. So I think it's something different. It's similar to say we have Tro. We've talked about Tro on this company before and along those lines, but I think the quality speaks for themselves. They just come down actually to a 3.3% dividend yield, which was quite good. I think historically they're in about 2%. So they do seem attractively priced, but it's still, I don't know about you, but I find it hard. I mean, I invest maybe 1,000, 1,500 right in a month.
Yeah,
I find it hard to spend it on 2.5
one
shares of
share. Yeah,
BlackRock. You know what I mean?
yeah.
That's what I struggle with. But honestly, I think they are a really, really good company to own.
So for me, they're an awesome company, and even more, always love to read the annual shareholder letter of Larry Fink. He is such a great visionary, and he effectively owns corporate world, I would say, via his ETFs.
Yeah,
It's amazing. They're in most of those funds. They are also the largest investor, or in most stocks, they are the largest investor as well. So, I mean, you own the world when you own BlackRock. For me, it is. I think assets under management will still be hit if we really get into a recession, or like a real one where there's no consumer
of course. Yeah,
confidence
yeah,
and people stop spending. What people will start doing also, and maybe already, is to withdraw their money from the stock market because they get scared. At that moment in time, T. Rowe Price and BlackRock will be hit even harder, and those will be for me the moments to buy because these are cyclical stocks.
yeah.
I agree with you that BlackRock smells like quality all over the place. So it is really, yeah, a good pick, I would say.
Do you know that's a very good perspective you put on it. Is with these guys is waiting for that moment of fear, because if we do hit a recession and we look, there's a lot of talk online, and we know retail investors particularly tend to panic a lot quicker. Institutional
Yeah,
investors, not so much. But if we start to see a little bit more panic, people are going to start pulling away from this market. It makes sense that asset under management falls
exactly.
down a little bit. Absolutely makes sense. So that's probably the right time. I'm going to make a note of that. It's probably the right time to look at these guys, Tro and Blackstone together, three, because
Yeah,
if you're going to make money with these guys, it's at the bottom of the cycle, not at when they were trading near $1,000 at one point. So
yeah.
it's a good point.
Good. So my second stock is, L'Oreal. I mean, this company, I've been studying European dividend stocks for so long. And I just, every time when I go to the L'Oreal website to update the Noble 30 index, you see these beautiful women with the lipstick, right? And how can you not fall in love with a stock like L'Oreal? I mean, tell me something different, because I mean, it's natural, right? It's really natural.
Because you're worth it. But again, it's a company that I feel that during a recession, and I think Europe is starting to feel some pain here. Uh, they'll prove me wrong. I have no doubt they're going to prove me wrong. But you always feel a company like L'Oreal, it makes sense for them having to drop during a recession. Like, who
Yeah,
can afford to be buying lipstick? Where they can't even afford to go out. They can't afford heating. They're not going to have lipstick. Do you know what I mean? So I feel like we might find a time where we can actually, because I think we've spoken about these guys
yeah,
from day one on the podcast, and if we had to listen to ourselves back in 2020, we would have been, even then we were saying they're overvalued,
yeah,
and they're after
yeah,
going up in
yeah.
price by about €150. So
Sure.
I think there will come a time when they will drop, and two of us have to make a promise that when it does, we're just going to buy it. But I do feel like during a recession, like most companies, I suppose, there's very few companies out there that when it comes to it during a recession are not going to be hit hard.
Yeah, and it's a foundational stock for me, a tier one company, and I still
Mm.
don't own even a single share. Maybe via my Noble 30 index buy, of course, on Trading 212. But other than that, I don't own anything. It's always been expensive. And yes, it came down a little bit during the COVID crash. But if you look at the all-time chart, I mean, this is like the example of an exponential growth.
Yeah,
How is it? Chart. But in November 2007, it was trading at 88 euro and it went down to 50 euros. So it did drop with, let's say, 40%. But if you now look, since it high of 420 euro, it went now to 325 euro. That's already, let's say, a 25%. So if it is in line with past drops, it might not drop too far from that point of view.
yeah,
So, but I can tell you, I know it's now at 325. Yeah, I know that this is still quite expensive. I've got a fair value estimate of 215 euro here, and as a baseline case, 277 as really a optimistic case. I really would maybe just to get used to it, buy 2 or 3 shares at 250 euro, just to really say that I have it in my portfolio. But the yield is currently at around 1.5%. So let's say at the 200 euro, I will be really, really interested. I know it's still like a 33% drop that it needs to do. But this is for me such a high quality company. But their dividend growth was over the last 5 years was 7.8%. And the issue that we have seen over the last years was multiple expansion. It wasn't
yeah,
so much earnings growth, it was really multiple expansion. These multiples need to come down. I mean, they're still trading at a what I say 35 PE or something like that. That's too high. That's too high still during these times. It's in the
yeah,
end, it's a consumer staple, a luxury brand, but a consumer staple.
yeah. It is. For me, it's too high, but as I said, we've been saying that since 2020, and it's never come down. But I agree. I agree with everything you were saying. I just really do think that we are going into a little bit of different time, and we might see a little bit. I know it's dropped similar to historical, but I think we're only at the beginning of this market crash. So I
I
think we have
so
a
hope so.
to
I
go.
so hope so.
To go. Okay, so my last company, I'm going back to technology, and it's one that I believe you've spoke of before, and I'm actually jealous of how cheap you bought these guys, but it's Apple. Um, I don't really own Apple products apart from an iPad, but I do love Apple as a brand. I think they've done incredibly well for themselves. Anyone that can create their own problem and then fix it, and then that problem that they fixed is it could be a company on its own. I think is actually incredible. They're really really well run. The dividend yield is quite low. We know this, but their dividend growth is high, which kind of offsets that. They generate huge amount of cash, which we know free cash flow is not a problem. They can obviously afford to pay more dividends if they really wanted, and I think they should. Um, and even during difficult times, they seem to be one of the only companies on the way up. I honestly think they're overvalued. I wouldn't like them at this price, closer to 100. I think I've said before. But it just seems that they can do no wrong. I know they've released a new iPhone now. It just seems to be so ingrained in people's lives now, don't they? Like, and especially the generation now that has probably grown up with these, you can never see them changing from Apple. It's mad. You talk to people, if they're Apple and you have a Samsung or an Android, they don't even want to pass you on the streets. Like, go away. We're Apple,
Yeah.
so it's quite
It's
amazing. But
really awkward. This is one of the only stocks that's still up compared to a year
yeah,
ago.
it's
Yeah.
crazy, like how well they're doing, and maybe a lot of that is to do with the iPhone that
Yeah.
recently came out and stuff. But I mean, I honestly thought they were going to come down. They were threatening to come down at one point, and we were both eyeing them up, and then they just took straight back
But
off.
if Apple starts coming down, then many signals will be triggering a lot of sell-offs because it's by far the largest stock in the S&P 500.
Yeah,
So we will really see the S&P 500 going massively down then. That's how I look at it. A PE ratio of 25, but the dividend yield of 0.6, right? But I'm with you. It's a high quality stock. I just hope there comes a new cycle again where all people say like iPhone is dead. I hope for that at least. Yeah, good pick, good pick. Tim Cook. I thought in the beginning he's like a bookkeeper,
Yeah,
but to create these AirPods, which are now, what is it, one of the best selling products in the world in revenue. It is amazing, right, for a bookkeeper to do that. So
I
yeah,
think yeah, like honestly, I cannot ever get over the fact that they took away the, the
the
jack on the
chords.
phone. Yeah, they took that away, left it off an iPhone. Everybody was giving out and they said, "Hey, hold on, we'll fix this problem for you. We've now made AirPods, but you're going to pay for it." And people pay for it, and that company, those
250
AirPods have.
euros. Yeah.
I mean, it's. I think I honestly, I just do not but admire him for that. The only concern, like the only real concern you had that is that the debt level is a little bit higher than what I'd like typically, but they generate so much cash that it's not really a
Yeah,
problem, really. So
that's true. And they got a triple A rating in December, so many people forget about that. They are not aware, but it's the third triple A stock in the world. So
yeah,
good one, good one. Hey,
you
look,
own all
my
three then?
yeah, I own all
Yeah, you
three.
own all three.
Yeah,
Nice,
yeah, it's 6% of my entire portfolio. Not too bad.
nice.
Hey, my third stock, it will really come as a surprise, probably, but it's Starbucks. And why I'm saying this? First of all, it's a high quality business. It's not necessarily the highest quality stock. Yeah, when we think about it. But why I'm saying Starbucks? Because I think they are back on track to be a really high quality stock again. I mean, I am so deeply impressed with Howard Schultz. He came back. When was it? In February, April last year.
Yeah,
They kicked out Kevin Johnson at the time, I believe was his name, because he was buying back and not creating really underlying shareholder value. And I looked at the Investor Day presentations as well, and they were referring to 2008, all the newspapers, how the brand was like starting to break, and then how they reinvented themselves. He started doing the same now, and what he has been doing in just few months is really, really. I mean, it just shows that a kind of a founder-led CEO, they really understand what the business needs and not these corporate, I don't know, CFOs or corporate tigers that were good in climbing the internal ladders, right? But these founders that have skin in the game, you can really see that. And I don't know about the new CEO enough, right? But if I see what he has done, so for instance, they really started to treat the baristas again as proper employees. They hiked their salaries, of course, also to offset a little bit the unionizing. But the unionizing was also, again, based on the complaint that there was not invested enough in them, right? But then I also read an article the other day about that the success of all these shakes and everything, right, is actually a pain in the ass to the internal process when you're a barista, because you need to do so many different things to create this thing that really delays and also creates longer queues. Now
yeah,
I read that one easy fix, yeah, easy fix is just buying better shakers or something like that, like these machines. So that's what they will do now. They will invest a lot in this. They will pilot this, but just the simplicity of such a solution, right? And you can only get to this if you're really co-creating this with your employees, and that's what they have been doing. I mean, they had 200 co-creation sessions to figure out how they can improve things, right? And you only do this when you really care about it, and of course you care in the growth, in the profit growth of the company. But if you know that your baristas are your asset, you know where you need to spend your time, and this is what Howard Schultz has been introducing. I'm not so happy with their balance sheet, with all the buybacks that they have been doing. Right? I've studied that time over time over time. At least I can say that from interest coverage, they are fine. I also analyze what the impact would be of higher interest rates. They can easily handle it. Yeah, and what I love now is they are now expecting 15 to 20% annual EPS growth over the next 3 years by the investments that they are making. They target the 50% dividend payout ratio and a 2% dividend yield as a dividend policy. And they target from, let's say, 2024, something like that, they target a 1% annual share repurchase after an interest at 3 times leverage. So clear rules in place. They really align with my own investment philosophy. And yeah, and from that point of view, Starbucks, I think we're going to see some recovery again in this business. And I still find the stock relatively, you know, around my buying zone. My buy zone is around the 70s, 69, 70. It's now trading at 85. So it doesn't take a lot of imagination to see this stock trading there again. I initiated a position earlier in the year when, Howard Schultz came in, stopped the buybacks and everything. I bought some at 69, I believe. So I would love to buy more again at that price. And for me, high quality business started deteriorating a little bit because of the former CEO being more caring about shareholders. I think they're back on track. It's simple like that. So count me in for Starbucks. It's an outsider, but this is how I looked at Apple at the past as well. Everyone said Apple is dead. I looked into it. I couldn't see it. I bought Apple. Yeah, and I had some really good picks with that, and I hope the Starbucks will be one of those.
You know, I'd be very biased with these because I had a coffee shop and I don't like their coffee, but the the more you look into them, the more you start to like, and there's a reason why a lot of investors start to like them. I know that they've announced what 15 to 20% earnings per share growth. Do you know if that includes China? Because I know China at the minute is their stumbling block because of all the
Yeah, it
lockdowns and
includes China, but they are a little bit more conservative on the China growth,
yeah,
revenue growth, not on the sales store growth. But I was last week in Starbucks for the first time in half a year, and I was surprised it was full. And to pay 20 zloty or something like that, or 70 zloty for a coffee in Poland, which is like 4 or 5 euros, that's really expensive. Yeah. And
yeah.
usually you should pay like €2.5 or €3 for a coffee. They charge 50% more just because you can sit there with your Apple book and act like a hipster. Yeah.
Yeah, it's true that they're full over here the whole time, and it's roughly the same price, €4 or €5
Yeah.
for a coffee. And one thing which I found was interesting was they have more stores internationally than they do in North America. I
Mm,
always associate them with America, but I
yeah.
think America now only makes up 49% of their overall stores, which
That, that
is
that was their
quite
growth, right? That was their
mm,
growth. But I do hope that they will make more drive-throughs because, for instance, you have also this Dutch Bros in America, which is quite popular. I mean,
yeah.
they haven't leveraged that enough yet. Why can't we have like McDonald's, like Starbucks drive-throughs also in Europe? Because for me, it's sometimes a struggle when I'm on the road to work. I would like to have a quick coffee. But
Yes.
then I need to step out of the car, walk into a shop, get a coffee. Or I have to go into the gas station. That's only when you go for tanking. Why can't I quickly run through a drive-through and get my coffee?
McDonald's do it over here, and it's great because there's McDonald's everywhere.
Yeah,
Everywhere you
McCafe
travel.
you can take. Yeah,
Yeah.
McCafe. But I mean,
Yeah.
I think it's a golden opportunity still. So once they have done all their store growth internationally, they still have these kinds of concepts, and still they are not selling proper food. We still get this junk stuff in the shops, like a cold apple cake. Who eats a cold apple cake? Yeah. So anyway, lots of opportunity. Starbucks would be my third pick. A little bit of an outsider.
Nice. Nice one. We probably went a little bit longer on those than we normally do than anticipated, but I think they are actually nice picks. I hope that we pick different companies for a change. We tried to stay away from Johnson Johnson's, Microsoft's, and the usual. I know for a long time we're getting given out to for Danone and Unilever and those types. So try to give some different perspectives, but I do genuinely believe these are high quality companies, especially during a recession. That if they do come down, some of them are richly priced. That if they come down, I think they would be all of them. With exception of Starbucks, I'm on the fence of, but everyone, all the rest of them, I would most certainly be in. But hey, we've got a portfolio review, the first one in a while from Casper Korniak, and he's sharing with us his portfolio. About his portfolio a little bit, he is focusing on quality right now, so he wants to make some bigger positions in the likes of Microsoft, Texas Instruments, Visa, and CSX. His long-term goal is to be as rich as fuck, since he is still a student and wants his kids to continue compounding. So I think, look, that's a decent goal. Looking at his portfolio, we'll go through his top five. Texas Instruments is 15%. Exxon Mobil, ticker symbol XOM, is 12.5%. GIS, ticker symbol GIS, is 8.9%.
That's General
And
Mills.
General Mills, yeah. And Coca-Cola, ticker symbol KO, is 8.2%.
And then number 5 is Shell on the London Stock
Shell,
Exchange for
which is
7%.
7%. Yeah.
Yeah. I mean, I like this portfolio a lot. Also, if you look at it a little bit down the road, he has also some Microsoft and Visa, AppFi. It's a strong portfolio. Texas Instruments 15%. I mean, that is really, really good. And what I also like is that he has some Coca-Cola in there and General Mills. So really like the flatliners, the stable ones, but also with a lot of loyalty to the dividends. So honestly, I like it a lot. You can see that if this has been bought recently, that he has been paying a lot probably for Microsoft and Visa and Texas Instruments, even to get to these kinds of allocation sizes. If there's anything that I would challenge here, I'm still wondering why does he have, AT&T and also General Mills at 9%. Is there still growth in this stock? I mean, the stock has been really struggling. Then during COVID-19, it became a bit, of course, in a growth track again because people started hoarding canned food and everything. I'm sorry, Casper, I don't know enough about General Mills, but in my opinion, I wouldn't invest too much in it. I don't see too much growth prospects in a company like General Mills. I believe they also made a really expensive acquisition at the time in a pet food producer. Yeah, but other than that, I would say like maybe some more healthcare. I'm missing that here as a long-term trend. Also from a sector point of view, it's upfee. I think there are some nice other stocks as well. Maybe even just Johnson Johnson or Bristol Myers, Sanofi. I don't know yet. They did get a good no, they will get probably a how is it an approval for a new vaccine for toddlers for against certain illness. That could be a big one. I think they're producing that together with AstraZeneca. But yeah, some healthcare, I would say.
When I looked at his portfolio, I actually saw a lot of similarities to my own portfolio. It's like looking in the mirror a little bit. There's some differences. I did notice AT&T, AbbVie, Altria, Unilever, Microsoft, and all those. But I think the composition of it was quite similar. And I agree with him. I think focusing on quality, similar to what I want to do, I think is a good idea here. You spoke about General Mills. Actually, they're doing a little bit like Apple as well. Actually, they're on the up. They're one of the few companies that are still trending up the way at the moment. So maybe they're doing something quite right. But I like the portfolio. It has a nice base to it. You mentioned healthcare. Yes, I kind of agree with that. There is 3.6% of stocks there that we can't see. So maybe there's a couple more there that are just smaller positions. But I mean, as the foundation, Texas Instruments, I think is a good foundational stock. ExxonMobil as well. Look, I think we all know oil is not going away. Whether that's the best company or not to own is hard to know. But they generate a lot of free cash flow. They pay a lot of dividends. At Dividend,
Definitely.
we thought it was in danger, but they just pull it out of the bag, and I think it's really important to them to pay that. So it's quite good. Coca-Cola is trending within a price range that I've said for about the last 18 months, and I don't see that changing until we know what's coming out of this recession. But I think it's a solid company to own. I think they've done some good things restructuring the company. For me, it's just a shame that they completed that right into COVID, and then we come out of COVID into a recession. So we're not really going to see the benefit, I don't think, of the likes of Coca-Cola and Pepsi and that until we come out the other side of this again, which for those who want to own it long term is probably a good thing to start, building positions in them. But no, I like it. As I said, it's similar to mine in composition. Focus on quality, I think, is probably a wise choice.
Good. Thanks for submitting, Casper. To the others, if you're also interested in having a quick few words from us about your portfolio, please share it with us on the Dividend Talk group, and we'll pick it up in one of the upcoming episodes. Good. Let's go through some of the listeners' questions. We're already quite far in the podcast, so let's see how quick we can get through these. So the first question is from Rafi Raber, and effectively he's mentioning that he's still in the accumulation phase, but he had a strategy in the past to sell every time a stock when it was 15% up, or even earlier when it was just 5% up, so that he would make more than on a saving account. He started dividend growth investing like several years ago, but he's now actually asking us, is it wrong to sell a stock which is up 15% or more to collect additional dividend income on the 15% return? What is your opinion on that one?
I think it's a normal conclusion to have in the beginning. I think I've had something similar, but then I've made that mistake before. I've sold some quality companies and bought other companies like Walgreens because the yield was higher and technically going to earn a little bit more income. But you tend to find out over time that the companies that are gone up 15% will probably go up another 15% and another 15%. And you'll be kicking yourself forever selling them. And then you become price anchored in that, oh, I bought them at $55 before, and now they're at $100 and I don't want to buy them. I want to wait for them to come down, and you miss out on them altogether. So for me, I've learned not to do that. And I try not to do that anymore, but I know it's a natural thing when you're beginning, you see the money go up and you want to take the profits. My other question to you, Rafi, would be, are you a dividend growth investor, or are you investing for capital appreciation? Because they're completely different and they require completely different skill sets and mindsets. If you're a dividend growth investor, turn off the notifications, turn off Twitter, turn off wherever you're getting your price information from, and just forget about it. Focus on earnings reports and what they do with their dividend, and that's it. And then you will never have to worry about if the price goes up 15% or down 15%. I can tell you my portfolio is down a lot more than 15% at the moment, but I mean, as we said, I'm a dividend growth investor. I've made more this year than I have last year in dividends, and it's grown more than I expected. So I'm quite happy. I'm quite happy with that. I'm not focusing on price. That would be my advice for someone that was in your position, has done what you're thinking of doing. I would say no, do not do it.
Super.
Not investment advice though.
Of course. And the next one is from Manuel Gallego Gomez, and he's asking whether we analyzed Holland Colors, ticker symbol AMS Holco. It's a Dutch dividend growth investing company, and he's saying good dividends and it's dripping now. So yes, I didn't hear about it before, but I looked into it. So Holland Colors is I believe making the, how is it, the paintings and the coloring for flexible PVC and such, really to support the construction industry. So it's really it's in that kind of industry. I checked the dividend history, and they didn't pay a dividend in 2020 as part of COVID. So yeah, that really took me off. Until then, it was nicely growing the dividend. It continued growing the dividend, but you would have just missed a full year of dividend income, which I don't like, which is a red flag. They didn't add it also to the next year, and if they did so, it was a dividend cut then over the 2 years together. So that means to me that the company is not committed enough to the dividend, and that's why I wouldn't even analyze it any further. That's it from my side, Manuel. And by the way, it is a really small cap, 110 million market cap. So really invest with wisdom here. Usually limited liquidity, which means if you want to sell it at a fire sale, you might not have any buyers at that time. So watch out with buying stocks in micro caps or small caps. Then the next question is from Lawrence Hembrook, and he's asking what our thoughts are on Colgate-Palmolive. We never really mentioned them on the podcast, despite them having roughly 60 years of dividend payouts.
Yeah, they have a really, really impressive dividend payout. And it's a company that I've no doubt will be around in the next 50 or 60 years. I mean, everyone knows the toothpaste, they use brands and stuff that everyone uses. But honestly, I've never had the desire to follow. They always seem way too boring. I've never had the desire to follow this company enough. They've never really popped up on my radar. And when I used to use screeners, they always missed out for whatever reason. And now when I look at companies, I just overlook them over the time.
Yeah,
But
the issue
I
is
know,
that the dividend yield is always too low compared to the share price, and although the share price is hardly moving over the last 5 years, it is always just not interesting enough. So usually it doesn't get into my screener. But hey, if you can get Colgate at a 3% yield and still decent payout ratio, then I'll be definitely a buyer.
good. And we have a question then from Matt. Any thoughts around the Nike price? It's starting to look juicy. What price would you be tempted to pull the trigger at?
Below $75.
Yeah, I think we spoke about them recently.
Yeah,
It used to be below 100, but then given recent events and how the market's turning out, I think below 80, 70 or 60 was
yeah,
around what we said. So might start dipping into them around 80. But again, look, that could change. We have to look at the outlook. We have to be realistic. If we go into a deep recession, are you going to be buying Nikes and Adidas? Or are you going to be buying
yeah,
your Pennies and Primark
exactly.
or stuff? So look, you have to think of long term as well.
Yeah.
Marek has asked us, what do we think about realty income? He doesn't always understand why people are so excited with it because the yield is low and the dividend growth is low.
Really simple. It pays monthly dividends. It has been growing the dividends really nicely over the years. And I'm with him that at 70, realty income is not interesting. For me, it's always been interesting around 50, although I have a buy order at 59.60 because I believe then it gives a 5% yield, if I remember correctly. Just a few shares, but consider me a big buyer in the low 50s. Until that, I found it a little bit overvalued.
Cool. Michael has mentioned that you have talked about buying some Microsoft for your kids. He's looking to buy some stocks for his own children, but he wants to know the best strategy approach for buying stocks for your children who cannot open their account and how to transfer later without minimal fees.
Yeah.
First thing I will say is that we can't really give you that advice. You really need to speak to a professional on that. I can tell you from my own experience, what I've done is that it's hard to open it for your kids in Ireland. So we've opened an account in my wife's name, and I honestly did not even care or think about the fees. When we hand them over, we will hand them over and pay whatever fees are due. My wife will have to pay tax on them if tax is due from now until they're 18 as well. Um, for me, the whole point is not to make them rich by the time they're 18. It's more of a learning thing. They're involved. One of them more so is actively involved in picking companies and going through the process and owning a portfolio and managing it. What the monetary value by the time they're 18 when I hand it over is not really that important to me. It's what they learn up until that point. So if I have to pay high fees, I pay high fees. But I don't know. I don't know. That's just what we did.
Yeah, same here. We opened the account on my wife's name, and that's it. And you can transfer shares as well. At the time, it will probably come at a fee. But I don't want that to drive my decision, because the alternative then is to not invest, because
Just
there are probably one or two banks in Europe where you can open something for the kids, but I haven't found a proper broker with low fees where I can do this. So in that case, I still want to be in the game for my kids. And if it comes a little bit at a cost, I don't know, at inheritance tax or gift tax, I don't know what it all is, then so be it. Because the alternative is not doing anything for your children.
yeah. Kevin has asked us, how do we choose our sector allocation?
Yeah, really simple. There are like 11 sectors, and I just look at which sectors I believe most in the next 10 years, and that's information technology and healthcare. And then the third sector that I think will do fine over the next 10 years is also consumer staples, and the fourth, energy. So that's where I want to be most invested in, and all the rest is secondary to that.
I've got 40% of my portfolio in consumer staples, so don't ask me how I allocate. It's uh, I look the way I look at it at the moment is I have an ideal of what I want, but right now I'm still accumulating. I'm probably going to be accumulating for the next 10 years by the looks of it. So I'm not going to focus too much on that. I'm focusing on now trying to buy quality companies, regardless of the sector, and then maybe as I get closer to some sort of retirement or some sort of when I'm looking for more safety, I will then try and allocate a little bit more to what I want. But at this moment in time, it's not as much on the radar as it was at the beginning. Good, good. That was the last question. Thanks a million to everyone for the questions. Apologies if the show was really long. I think didn't expect it to be. We picked quite a light topic, I think, because we had to postpone this for a couple of days because I was working late and sick and so on. But thanks to your patience, we are going to release this as soon as we can, and we will see you all next week.